Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Enbridge's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 108 billion Canadian market cap. They're trading at $51 a share, and they have 2.1 billion shares outstanding. Since they report all their financials in Canadian dollars, we're looking at the ticker that trades on the TSX. So the numbers on my Excel file are in Canadian dollars. Enbridge owns and operates pipelines throughout Canada and the US. They transport crude oil, natural gas, and natural gas liquids. They also generate renewable energy. Their pipeline system is the longest in North America, and they have the largest oil export pipeline network in the world. Its crude oil system consists of 29,000 kilometers or 18,000 miles of pipeline. Their 38,000 kilometer or 24,000 mile natural gas pipeline system connects multiple Canadian provinces, several US states, and the Gulf of Mexico. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had over $4 billion of free cash flow in 2020. It fell a lot in 2021 to $1.2 billion. Then it blew up in 2022 to $6.4 billion, their highest ever, over $9 billion in 2023. They pay a big yield, 7.25%, which cost them $7.8 billion in dividend payments. Their free cash flow is higher at $9.3 billion, but it looks like in prior years they didn't have enough free cash flow to cover that dividend. Hopefully they can maintain the dividend payment and not have to cut it at all. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also up and down. A solid $6 billion in 2023. It was a little higher in 2021, $6.3 billion. Pretty good margins. They converted 14% of their revenue into net income. Revenue is the sales for the company, and that peaks in 2022, like most midstream stocks, due to high oil prices, and comes down a little in 2023 to $44 billion. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $133 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $114 billion. We divide that by 2.1 billion shares. And we get a calculated stock price of $54. They're trading at $51, so they're trading at a 5% discount. It is a small buy according to the model. There are 48 companies in the same industry as Enbridge, and if they have a number in red, they're worse than median. If they have a number in blue, they're better. I converted Enbridge's numbers to US dollars because all the other tickers trade in the US. So I wanted to compare apples to apples. Enbridge spends a lot on CapEx, $3.7 billion. TC Energy spends the most. These are investments in their pipeline terminals, not just when they lay down pipeline, also to maintain the pipeline. It's similar to a telecom company. A lot of the CapEx is to maintain the infrastructure because AT&T has to lay down miles and miles of cables, but they have to spend a lot of money each year just maintaining all those cables. Same thing with this company or any company. CapEx is not just the new property, plant, and equipment. It's also the maintenance of the old stuff. Most companies are a bit leveraged in this industry. Their debt-to-equity ratio is 1.3. For every dollar of equity, they have $1.30 of debt. They pay a nice dividend, as do most. Frontline is the highest, 8.7%. My favorite midstream, ET, 7.8%. I also like MPLX and One Oak. Maybe I should invest in Enbridge. They look like a pretty solid company. They generate the most free cash flow, close to $7 billion. That's US dollars. They're the biggest company in this industry, close to 80 billion market cap, 80 billion US dollars, 100 billion Canadian dollars. They have a good price to book, 1.6. They're trading at 18 times earnings, which sounds good, but it's worse than the median average. They're trading at 12 times free cash flow, a lot better than the average, a little worse than the median. Trading at 2.5 times revenue. When someone says trading at 2.5 times revenue, that means their market cap is 2.5 times their revenue. They're not growing anymore. Their 5-year annual revenue growth rate is negative 1%. Look at Intero, 81%. Most companies are positive, so that's not good that they're negative. If you put $10,000 into this company 10 years ago, you'd only have $13,000 today, a 26% return, a 2% annual return. Because that's not a good time to invest in oil stocks in 2014 because of the crash in 2015 and 2016. You can see how low it got. If you invested in 2016, at the end of 2016, your $10,000 would have probably been $30,000 today. Or even better, if you put $10,000 in April 2020, you'd also be at $30,000, $40,000 today. I put about $50K in January 2022 into Energy Transfer, not this stock. So I'm up a little over 100% with the dividend. Enbridge is the green line here. This is their stock price the last 5 years. It's up about 1% it looks. And the price of Brent crude is up 17%. That's the dark red line. Williams is doing the best, up 41%. Kinder Morgan is the worst, negative 5%. They recently released their first quarter results. Let's go through them. Here's their income statement. Revenue $11 billion for the first quarter, down from $12 billion. All their numbers are in Canadian dollars. They give a nice little breakdown right here. $4 billion in commodity sales, so selling crude oil and natural gas before the refining process. Gas distribution sales $1.7 billion. Transportation and other services $5.2 billion. That's pretty much the definition of midstream transportation. It's moving oil from one party to another, usually from downstream to upstream. And they do it by pipeline, but some companies do it by vessel, some do it by truck. But pipeline is the most common way to move it. Here's a different breakdown of $11 billion. $7 billion from liquids pipelines, $1.6 billion from gas transmission, $2.1 billion from gas distribution and storage, very little from renewable power, $130 million. Eliminations, that just removes the overlap because some numbers are in two categories. So they eliminate here, so there's no double counting. Let's go back to the income statement. Operating expenses $8.3 billion. You can see the cost of the commodity is $4 billion. They sell it for $4.1 billion, so they don't really make much margin on that. Gas distribution, their expenses are $1 billion. They sell it for $1.7 billion, a lot better margins. And they have operating expenses like payroll $2.1 billion, depreciation and amortization $1.2 billion. They have to depreciate their fixed assets, their terminals and pipelines. Operating income $2.7 billion, up a little from last quarter. They have investments in other companies. They earn $700 million. Those are income from equity investments. Their net income or earnings $1.6 billion, down from $1.9 billion. The reason their net income is lower this quarter is they had a big negative in other. Let's see what that is. Oh, this is derivative contracts. So they must have hedged the price of oil or interest rates. Here's a better breakdown. It was foreign currency loss of $858 million because they deal in different countries, US, Mexico, Canada. So rates went against them. Their EPS is 67 cents, down from 86 cents. Let's look at their balance sheet. $10 billion of current assets, $15 billion of current liabilities, so a pretty weak current ratio. They may need to add some debt to get through the next 12 months. Most of their assets, the $191 billion, is PP&E, property, plant, and equipment, namely the pipelines. They also have a lot of goodwill from acquisitions, $34 billion. Their total liabilities, $123 billion. Their biggest is long-term debt. Assets minus liabilities equals equity, $64 billion of equity. They raised $7 billion from selling preferred stock. They raised $69 billion from selling common stock. And they lost $16 billion from running their business. If you want to know how they come up with the negative $16 billion, you can look at the report, Consolidated Statement of Changes in Equity. And it breaks that down in a lot of detail. Anything in the equity section, it breaks it down. Let's take a look at the statement of cash flows. The first section is operating cash flow. And the way you calculate operating cash flow, you start with your net income, $1.6 billion. Then you add back the non-cash items on the income statement. The biggest one is depreciation, $1.2 billion. Then we have to add back an unrealized loss of $700 million. They pass through a gain of $700 million. We have to minus that out. That's a non-cash item. And then we have to adjust for changes in working capital, negative $300 million. So they generated $3.2 billion of cash flow, down from $3.9 billion. In the investing section, they added $1.2 billion of capex. They did a lot of acquisitions. They spent $6.4 billion of cash. If you want to learn more about their acquisitions, you can Google it. You can also find it in this document. They have a whole section, acquisitions. They talk about their acquisition of the East Ohio Gas Company. They acquired all outstanding shares of this company. This is not the ticker EOG. This is just the term they use. There is a ticker EOG for a different company. And they paid $5.8 billion of cash, $4.3 billion US dollars. And they tell you a little more about the company, what it does. They are a public natural gas utility providing distribution, storage, and transmission to residential, commercial, and industrial customers in Ohio. They acquired this company under ASCII 805. So Enbridge has to value this company's assets and liabilities, then consolidate all that onto their financials. And they give a further breakdown of the assets they acquired, the current assets, the PP&E, which I guess is the big one, $7.3 billion. They also have to take on their liabilities, long-term debt of $2.6 billion. Enbridge's goodwill goes up $1.6 billion from this acquisition. That's the premium they paid above the net assets. So $1.6 billion is the goodwill. This is their balance sheet. Their goodwill went up a lot more than $1.6 billion, so they must have acquired other companies. Let's go back to the statement of cash flows. So in the investing section, they had a cash outflow of $8 billion. In their financing section, they added $5.8 billion of commercial paper. This is short-term debt. They repaid $3.8 billion to debentures. Debentures are unsecured debt issued by this company, and they paid out $2 billion of dividends. That's just for the quarter. So in their financing section, they had a cash outflow of $120 million. You see cash at the beginning of the period. Beginning will be 1/1/5985, and the end of the period, which will be 3/31/1385. These numbers will match the balance sheet. Watch, 5985. That's the sum of the cash on 12/31, which is the same as 1/1. 5901 plus 84. Cash at the end of the period, 1385, is a sum of these two numbers, cash and restricted cash. 1214-171 is 1385. That's the cash as of 3/31/2024. Let's take a look at the stock on Simply Wall Street. Its last price 52, 110 billion market cap, up 4% in the past week, down 1% in the past year. I just did a video on ET, another midstream company, and they were up. I think it was like 30 or 40% in the past year. Let's see what they say about the company. Enbridge operates as an energy infrastructure company. They have 5 segments: liquids pipelines, gas transmission and midstream, gas distribution and storage, renewable power, and energy services. The liquids pipeline segment operates pipelines and related terminals to transport various grades of crude oil and other liquid hydrocarbons in Canada and the US. The gas transmission and midstream segment invests in natural gas pipelines and gathering and processing facilities in Canada and the US. The gas distribution and storage segment is involved in natural gas utility operations serving residential, commercial, and industrial customers in Ontario, as well as natural gas distribution in Quebec. The renewable power generation segment operates power generating assets such as wind, solar, geothermal, waste heat recovery, and transmission assets in North America. The energy services segment provides physical commodity marketing and logistical services to refiners, producers, and other customers in Canada and the US. They used to be known as IPL Energy and changed their name to Enbridge in '98. They were founded in 1949, 75 years ago, headquartered in Calgary, Alberta, Canada. Here's the stock price way back in 1990. Imagine getting it back then. Your dividend would probably be over 100%. And it had a really amazing run up to its highest point ever in 2015, $65. But then the oil crash at the end of 2015 brought the stock down like all other oil and gas stocks. Then it went up, came down, went up, came down, and it got low in COVID in the 30s. And that would have been a great time to pick it up. It did have a really nice run up to almost 60 in 2022. That's when oil got real high. Then it came down to the 40s, and now it's coming back up a little bit. But it's still trading lower than it was right before COVID. Simply Wall Street is really bullish on them, 87 a share. They say they're 40% undervalued. 22 analysts priced this stock at 53, so they're pretty close to me. Their revenue forecast for 2024 is $46 billion, 2025 $48 billion, 2026 $52 billion. And free cash flow, $6.6 billion for 24, $6.8 billion 25, $8.4 billion 26. They need to be north of $7 billion to cover that dividend payment. Back in 2013, they had revenue of $28 billion, and it peaked at $53 billion in 2022. It's come down to $42 billion currently. This red line is their debt, and the blue line is their equity. They track each other pretty closely. Debt of $88 billion, equity of $67 billion. So like most midstream companies, they have quite a bit amount of debt. And this green line is their cash. They keep very little cash on their balance sheet. It's funny, $1.2 billion of cash is very little, at least relative to their debt and equity. Their next dividend payment is on May 31st. See, the ex-dividend is May 13th. So you want to own the stock May 12th or before to get that dividend payment. Their yield was low in 2014, under 3%. In 2020, it peaked at 8.2%. It's been coming down, but still a pretty nice yield at close to 8%. The forecast is 7.5% for 2026. The CEO's salary is 1.8 million Canadian dollars. Total compensation, 19 million. Tenure as CEO, 1.3 years. Greg was CEO of Spectra Energy from 2009 to 2017. Spectra was acquired by Enbridge in 2017. That's how he ended up becoming the CEO of Enbridge. In the past year, there's been some insider selling, but mostly buying. Here's their CEO, bought 17,000 shares. And there's a few more on the list. 58% of the company is owned by institutions and 42% by the general public. BlackRock is their biggest shareholder at 5%, then Vanguard, RBC, Royal Bank of Canada, BMO, Bank of Montreal. More Canadian banks own the stock. Their employee count was 8,600 in 2013. Now it's 11,500. And the ticker trades on the TSX, New York Stock Exchange, Deutsche Börse, London Stock Exchange, Bulgaria. The ticker trades on the TSX, New York Stock Exchange, Deutsche Börse, London Stock Exchange, and Bulgaria Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.